Okay, we are in the midst of a strong bullish market here with very light volumes and very small ranges. Is that a problem? And how much upside do we have? Are we overextended as it is? I'm going to break those questions down from a technical perspective to see, number one, what these volumes mean to us, and number two, how much potential we have in this strong bullish market that we are in right now. So we're going to break that down. We're also going to take a look at what's driving this action and whether or not the Fed may not raise rates in July, according to some chatter that's out there. And then finally, our trade idea of the day takes advantage of a multinational company that's been impacted by this trade chatter and trade news and the stronger dollar. And we'll see how we can trade it with its earnings coming up. So let's go ahead and get started. Today is Monday, July the 15th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 here. Excuse me, with the market forecast indicator. We ended up finishing here just above break-even, about as close to break-even as you could possibly finish, right about 30.14-ish. We did get up to a high of 30.17 today, of course. Small, very, very, very small range, not even half of the average. You can see that the intermediate posture remains strongly bullish. The near-term line is also easily still up in the upper reversal zone, and you have the rising market sentiment. So yeah, again, dark green line, dark green shading, rising green line, and rising market sentiment. That's the three, from an intermediate standpoint, those are the three good things you want to see. And then, of course, from a short-term standpoint, you want to see the blue line above 80 in the midst of a 7 to 12 day above 50 run without the momentum line dropping to extreme lows. So, I mean, as long as we get that, we're good. And that's what we got so far. We're good. We've had the near-term line now 4 days in the upper half of the chart. And 7 to 12 is your typical time frame you like to see there before you do like to see it pull back 1 to 3 days here below 50. And so we continue to ride this trend just like we expect that we would. The posture remains bullish on the S&P. It remains bullish on the Dow Jones, and you can see it's even kind of more bullish there. If you look at the linear regression trend line, I didn't want to show you that one. You look at the linear regression trend line in some of these, because you think, okay, well, some of these just have to be getting too bullish, right? Well, again, here's the 1 year linear regression. And you can see we're not anywhere close to being too, from a linear regression standpoint, we're not anywhere close to being too bullish on the Dow Jones or the S&P 500. Of course, the Russell 2000 is actually on a bearish trend over the 1 year. So, and then finally the NASDAQ Composite here. Fat finger that one. So NASDAQ Composite the same. So we're not even up to the first standard deviation channel. Just to kind of give you in the context of what this can look like when you do get to an extreme. Let's go back to, as you all know, this time frame here when we got up to, what was that, January the 25th, when we really peaked there. So if I were to switch my time frame here to January the 25th of 2018 to see what the 1 year linear regression looked like then, so that would be January the 26th of 2017, you can see that we can get to an extreme, and of course that led to a pretty significant sell-off. If I were to go back here, not every sell-off comes from a significant extreme. You can see back over here, we got up to, let's say, by about 10.3 of 18 before we started this selling. 10.3 of 18, if I were to draw my custom time frame to that level, 10.3 of 2018. There we go. I didn't hit enter, so it's 10.3 of 2018, and of course before that would be 10.4 of 2017. You look there, and we didn't get to an extreme, and we started to sell off at that point. Again, partly because of how bullish that move is. But you can see we can really move. This thing can really take off, and we're just not. I mean, that even the trend at least was a lot more bullish on that 1 year period. The trend is relatively flat here, and it has an up. In fact, well, here's where we're at right now, and you can see how much we've rallied up from the beginning of the year to this year, and then you compare that to that same 10-3 time frame of when we peaked last year before we started the decline. We didn't quite get to like even the first standard deviation level, but you look at how bullish. Look how bullish the linear regression, how strong the trend was to that point. So again, it kind of gives you an idea. You see how strong the year-to-date or the 6-month returns were. I've shown you that chart before. If you look at the rate of change on the S&P 500, we'll go back, say over like the last year, we're at 3.6. Well, let's go a little bit longer on the time frame. Let's go back 10 years. You can see up to that point in October, we were more. Not only was it linear regression a lot at a steeper angle, but we were at about a 7.75% 3-month return, which is kind of the peak. For that we have hit it multiple times. We're only about 3.5% right now. So again, there's room to the upside for this to run without getting to the point where it's such extremely overbought in this intermediate term. And going back to the market forecast chart, the expectation is 1 to 3 months. We're now past 1 month. So could we get another month or two? Definitely within the realm of possibility, especially considering what we have on the table. And you can also see too, the other charts I like to show you is the Ichimoku cloud, how bullish that is. We have just barely gotten through the cloud back here in June. So the market forecast was just a little bit earlier. Then we got through the cloud. Just for some context of how long we can, once we get through a cloud, how long we can stay above a cloud. It can be a long time. So we just barely started. So we are relatively high up above it, and we that's not out of the realm of possibility here. But getting through it to the upside can lead to a pretty extended move. That's on the daily chart. You look at the weekly chart, we had gotten down to the cloud and bounced off of it, and you can see just how bullish we remain to be there, and how bullish, how long. After coming down and back through here and then retesting, it's similar to here, come down, come up, retest, and then you can see we can stay above a weekly cloud. Granted, that was 2017, and I don't expect that we'll have that much of a move, but if I were to go back even further for some additional context, there's that period right there, similar to this. Just, it doesn't look the same, but if I were to do a log scale here, then it doesn't look that different, right? So very similar to that period. So here's 2011, again, getting through the cloud, coming down, but you can see, now this was QE3 fueled all the way through here, but you can see that we can stay above, even here, above the cloud for quite a while, from 2010 to 11, before we run out of gas. So lots of room. Not necessarily that we're going to make a multi-year run like we've seen in the past, because we are different in terms of like the cycle of the business cycle, the stage of the business cycle. We're not in early stages of the business cycle. We're more in late stages. But it also means that we're not like imminently at a looking at a peak, and for the market to start tumbling down from these extreme overbought levels. That's hardly the case. And if I go again one more time back to the market forecast, you can see that yes, I'm 1 month in, but this market sentiment line, which we do expect 6 to 9 months, that was February 20th. So 6 months would be in August 20th, and then you go on to that 9-month mark of November. So that can stay above 50 and stay in a bullish trend for we still potentially could have a month to even 5 or 4 more months left in this kind of multiple intermediate rally run. Okay, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also a button down below this video if you're watching this on YouTube. That will notify you when these videos are posted. Also, while you're down there, click the thumbs up icon. That tells me 2 things. Number 1, you got something out of our video. Number 2, that you want us to do it again tomorrow. So If that's the case, if you want us to do the video again tomorrow, please click that thumbs up icon, because that's the only way we know. That's the way that we get feedback from you. You can do that right now while you're watching. Also, while you're down there, comment. What did you get out of the video today? New people come to the video all the time. Comment on what you're getting out of it and why you think that they should watch it. Join our Market Outlook email list. We have an email list that we send out every day with links and watch lists. Make sure you subscribe. There's a link popping out right there. Click on that link. It's a very easy way to subscribe. Follow me on Twitter for more content in between videos from day to day, and join our Market Outlook community that we created on Facebook. We also invite you to subscribe to our website at marketscholars.com. If you're watching our video, you can do it right here up above to the top right. If you're not, just go to marketscholars.com. You see our address up here at the top. Then go to our blog, click on blog, and then you'll see today's post. Again, very, very easy way to subscribe. It's free. It allows you to participate in our Market Outlook forums. Of course, our premium subscribers, our paid subscribers, are allowed to go to our classes. And you can see our full schedule of classes with Brandon coming back tomorrow from his weekend off, and then back to my normal options classes. If you've subscribed to our real-time trade alert channel that we have, our subscribers have, I've been pretty busy today. So those that are watching the video that are Market Scholars, make sure that you're subscribed to that channel to be up to date on what trades I put through for our classes in between our classes. All right, now let's get back to the charts. Let's take a look at the long-term chart for the S&P. Of course, very, very small range today, so you can see what context that looks like. But again, rising 50-day moving average, rising 200-day moving average, or above both. The gap between the two is getting bigger, according to the PPO indicator down here at the bottom. If I were to look at the Heikin-Ashi candles, you can see how big this week's candle is. We already are up to new highs. The open is 29.69, so that's how much room to the downside we have to trade if we start to get any kind of near-term pullback, which, again, we're 4 days into a near-term rally. The expectation is 7 to 12, so probably most of this week, depending upon how the markets react to individual earnings results, we'll probably end up staying up towards the upper half of at least this Heikin-Ashi candle this week. You'll see that more here in just a second. If you look at the 3 green arrow chart, not surprising, we got 3 green arrows, but we do have a slowing momentum. And again, you look at the 3 green arrow, the 2 line versions, you can see why. The orange line is relatively high. It was higher over here, but we were coming off a much bigger low point. So, in terms of being as bullish as we are, that's a pretty high level. You can see during this rally, we never did get this bullish. So we've had a couple of pretty decently bullish rallies here, kind of akin to what we had here, but this was at the end of a move, not at the beginning like these. So this is your typical surges, and when you get your typical surges in the MACD, we start to grind. We don't typically V, on this orange line. You see how the orange line will V up, but it usually doesn't V down, right? It usually doesn't go straight down to below zero. It does come straight back up above zero. But it usually will grind its way down, and that's kind of the expectation. We are above the 8-day moving average still, so again, to get 3 red arrows, you got to be below the 30, and we're well up above the 30. If you do take a look though, here, let's get rid of the stochastics for a second, and take a look at that MACD and look at how far up above the 30-day moving average we are in context of where we've been in the past. So we'll do simple. At least a recent past. Again, you can see not as bullish as we were here, but over the last couple of years, about as bullish as we were at the end of this intermediate. This was a 5-month intermediate rally of a typically 1 to 3 month range. So that's about how bullish we are. Again, that's your surge. We've had our bullish surge, and now we will probably grind our way towards zero as we point our way higher, similar to here where we surged off the low and then we're grinding the rest of the way up while the orange line made its way down back towards zero. Let's take a look. The other reason why we have a good chance to grind here is because we're well above the value, and we're not well above, but we are above the value area here in the S&P 500, and that's breaking out of that value area after having been below it even is a very, very good sign for the markets. It's hard to get through it, and that's why we were kind of stalling here. But once you get up into it and you get towards the top of it and you get through it and you get to the upper half, above the point of control, and then you get through the top end of it, now we grind, right? It's not going to be a rocket ship to the moon because volatility is not high right now. We get the rocket ships to the moon when volatility is high. That's not the case right now. But, we do have, pretty decent odds of just grinding our way up and down, but grinding our way up throughout most of this year. If not, like I said, towards the middle of November, which would be that 9-month market sentiment rally. All right, now let's take a look at the intraday charts, and you can see the grind today, and we stayed below last week's and last Friday's high point by the end of the day, but we are still kind of in the middle of the range, higher high, higher low, very tight. The range is going to tighten up at the next couple of days, the overall range to about 10 points, which is going to be less than 5%. So again, more room to the upside based off of that with this low point. And then after that, the low point's really going to start moving up once we get past that level, but that's not going to happen for a couple of weeks. So over the next couple of weeks, kind of the rubber band limit that we have to the upside is probably to about 305-ish in that area before we kind of run out of gas. At least maybe not in this particular near-term run, but in the next one, if not this one, the next 1 or 2 near-term runs. Again, within the next couple of weeks here before we stretch our limits. But then this will start to move up. And again, if we start to really go sideways with the low moving up and we tighten up that range to below that 2.5% mark, then there's a good, opens up the likelihood that we'll get that intermediate reversal occurring at that point, which would not be a bad thing. We're coming down from a higher intermediate high, and you can't have a trend without higher highs and higher lows. So at some point in time, the intermediate reversal will occur. We just, would expect, if you're in a bullish long-term trend, that the next intermediate low point will be higher as well. If you take a look again at the range today and the volume here, SPY, then you see, again, less than half the range. Very, very light volume. Again, this is like holiday trading volume, but it's on a full day scale. So that's, very light volume. And again, that's not necessarily a bearish thing. It's not the most bullish, but it's not necessarily bearish because that's what happens. That's what happens. The ATR comes down, as you see over like a longer scale here. The ATR comes down, then it can stay down, and the ATR right now is still relatively high to where we've seen it in the past. So this can come down. The volume is not at an extreme. It's at the low end of its range, but it can stay down here for a while. We're just now getting down to this area. So having small ranges and small volumes is not necessarily the most bearish thing. Eventually, when we get to oversold conditions, it can be. But what it does mean is that we are entrenched in this bullish trend. And finally, looking at volatility, you can see, we are right in the sweet spot of the bullish range for a volatility. The bullish, not bullish for volatility, but bullish for stocks, bearish for volatility. So we're right in the sweet spot of that range here at 85%, getting below 80 is extreme. So we expect a bounce in volatility at that point. Not anywhere close to that right now. And we're still, kind of with today's little bounce in volatility, we're still at about just under 13. So we're not bouncing, but we're not extremely low either. So it's right in that sweet spot for a summer grind. All right, so before we look at what's driving the market today and then concluding with our trade idea, I'll take a quick pause and just summarize our posture and get your vote on it. So again, the posture remains strongly bullish. The near-term move is slow, it's grinding, but it's still to the upside. Still not even expecting a near-term pullback. Of course, anything can happen with earnings season upon us. There's potential for headlines to move markets, but just from a simply technical perspective, we still are looking for that near-term pullback or near-term run. We're still in the midst of a near-term run without any immediate pullback coming up. Unless something changes. That's our current posture. So, and it's a pretty decently good bullish market that we're on right now. So not one that we are worried about getting to overbought conditions necessarily anytime soon. So with that being said, what do you think? Do you agree with that or disagree? There's a poll right there. Click that link. It opens up that poll on the right. then hit either agree or disagree. If you click disagree, comment down below what you see that suggests maybe either you should be more bullish, or less bullish or more bearish than what our outlook routine here suggests. All right, now let's talk about what's driving the price action today, and take a quick look at the calendar. And really the only economic indicator we had that came out today was the Empire State Manufacturing, and which had been pretty strongly negative for the first time since 2016. You can see when we were in a global recession, but not a U.S., more of a U.S. slowdown throughout 15 and 16, the last time we had the death crosses, you can see how negative the Empire State Manufacturing got then. And that wasn't really, we didn't really slow down on the economy here as much as we did globally. Very similar to what we see here at the end of this year. But if you take a look, and another sign that I look at that is something that Ryan Dietrich tweeted out and I retweeted. And this is what the Baltic Dry Index got down to at the beginning of 16. Again, when we were at the kind of the bottom of that economic slowdown, global economic slowdown. Just not nearly as much of one here. But you can see, we bottomed out here too, same thing, and then we've really rallied. In fact, the decline that we've had from that July-August timeframe when all economic indicators rolled over, we have now exceeded those highs on this. So very, very good move for this index. The other thing I wanted to point out too, here is what happens to the stock market, or the Dow Jones Industrial Average, around when the Fed cuts rates for the first time. You can see here the different recession and non-recession levels of when they cut rates. Again, a lot of people are looking at this as very similar to 1995 rate cut cycle. This is something I've been looking at too. Well, the blue line talks about what the Dow Jones Industrial Average does a year later if there is a recession in that year, right? So the Dow Jones Industrial Average does still move up, a little bit here, not as much, but it does move up about 10% or so in the years after the first cut, when they do have a rate cut cycle. So think about, again, September of 2007, the one of these instances right here. That was before the market really dropped sharply in October of 2008. So just 1 year later is what it's looking at, and that was only one of these examples. But here's the red line, is how much it returns in the next year after the cut when there is no recession, which is not expected within the next 12 months here in the U.S. And you can see how significantly the stock markets rally. So a couple of things that stood out to me over the weekend I wanted to make sure that you saw. Because I do believe that these economic indicators have pretty much bottomed out and are looking to start to rebound. I mean, not rebound immediately back up to these peaks, but as we saw over here in 16, coming off of these lows, where the lows just weren't as significant as they were in late 2016. In terms of whether or not there was some discussion about, well, maybe the economy is not so bad that we don't need the rate cuts anymore, and the Fed might not deliver on what the market's expecting. The market's still expecting. In fact, today the market's expecting a higher likelihood of 2 rate cuts in September, and you can see the odds of another rate cut, second rate cut by the end of the year is still over 90%. So that's more than likely they're going to not only do a rate cut in July, but a second one by the end of the year. At least that's what the futures market is pricing in. So we have to keep in mind, the Fed's not just looking at the economy as a whole, they're looking at inflation expectations, which have really dropped off significantly. They're starting to rise up a little bit here, and which is a very good sign that this might not be an extended rate cut cycle. Similar to 95, it might just be 1 or 2 here and there as we need it. As I showed you before, in 95, well, it's actually in the 10-year yield in 95, we actually did bounce before rolling over, and you can see the 10-year dropping below the Fed funds rate is your reason why we need to cut, right? This is the major reason why. If we're up above it, up in this 1 to 2% range, you don't need it. But again, since October of last year, the 10-year has really dropped significantly relative to, and again, you saw here 95, as soon as similar to back in 95, we got down to 0. As soon as they stopped, they only did 3 cuts in that cycle. We rallied back up again. The 10-year came off of the Fed funds rate significantly. So You know, that's the expectation right now. Again, barring a recession within the next 12 months, which we're unlikely to get, you can see we typically do drop below zero before we have these recessions, these gray bars here. But you can also see there are other times that we drop to zero or below without getting into a recession, at least in the next 12 months. So in terms of like how things performed today, again, bonds came down. Bonds actually rallied today, but they're continuing to pull back. The S&P is still holding up really good. The small cap index had a little bit of a decline. In fact, if I just look at today and you see what happened today, you can see the small cap index started the day off pretty negatively and then stayed pretty much close to its lows. Emerging market stocks did very well, and that's a good sign. With the weakness in the dollar, you would expect emerging markets to rally. In this case, emerging markets rallied with a little bit of strength in the dollar today, and then crude oil really and with crude oil dropping. So those two factors, which are kind of tied to emerging markets underperforming, emerging markets were still able to do very well despite those two things. Let's take a quick look at the foreign markets and their 3-month grids here, 3-month charts. And you can see, you know, you've got Russia, which is doing very well, Brazil pulling back, China bouncing off of its lows, Korea trying to figure out its low points, India coming off of a potential double bottom low here, and with a really decent move up higher today. So it wasn't the biggest gains, but outpaced the U.S. gains, and especially outpaced some of these other developed market losses. Germany had the best gain today overall, but still is very, very flat and unable to really get a trend going. It's got a bearish intermediate posture and doesn't have the green line. Well, we'll have the green line tomorrow, but it's not quite getting into that trend like you see in Italy, but you don't really see in any in the UK or in Germany quite yet. You actually do see it in France as well, as trying to get this strong bullish posture going with that rising line. You just don't see that same pattern across a lot of these others. You see some good signs in Italy, Russia, Canada, Brazil, but Korea, which has been trading very similar to China, still really lagging behind there. And a lot of people look at Korea as kind of the sign of the kind of the chip technology space and expectations going forward in terms of how well that they're doing. So with bonds bouncing back up a little bit today, not surprising to see utilities and utilities ended up today pretty strong. Real estate started the day relatively strong too. In fact, if I just look at today, similar to what we saw on the other chart, I go to the 15th here. Let's go to 10-minute charts. Again, you can see there's utilities, there's real estate started off strong. Real estate did pull back at the very end of the day, but you see technology and discretionary finishing the day relatively strong too, and that's a good sign for bullish markets to see those cyclical areas outperform. You still have some weakness in energy, you still have some weakness in financials. They lagged behind today. Financials needs to see those yields bounce back up again, and then you'll see them bounce back up as well. They have a big week this week with a lot of financial stocks. Citigroup today, JP Morgan tomorrow, among others, that are reporting earnings. And industrial also one of the laggards for the week. If you were to go back to the last 2 weeks, right here, there we go. Again, you can see where the strength in the market has been. Real estate did well. It's pulling back a little, but communication services, discretionary, technology. You still have your safe havens that are up here during this kind of bout of volatility. But off of this low, I guess you could say it from Wednesday, what would that be, the 10th? Yeah, let's just switch this to Wednesday the 10th. From that period going forward, you see there's your cyclical areas really outpacing the market going up, and consumer staples holding its own, but utilities and real estate and healthcare really last week, last Friday and actually Thursday and Friday, for different reasons, really struggling, kind of bouncing up a little bit, but all these safe haven areas lagging behind since the market bottomed and has been bouncing up, 1% over a few days, the forward trading sessions. All right, so for our trade idea of the day, I want to take a look at Caterpillar. Market scholars would know, those that come in my class know that This is a stock that we've been kind of looking at and following and trading. You can see it's close to an overbought cluster with the rally up today on the near-term line to extreme highs at the last couple of days. Really strong moves, approaching some resistance. We'll take a look at that in a second. And you also have earnings coming up here. If you take a look at the long-term view, you can see Caterpillar has pretty much no trend. I mean, the momentum is really, really small sideways as it really is unable to break out one way or the other. And you could say we're kind of at the top end of the recent range, which was the low end of the prior range in the first 3 quarters of 2018. Well, since then, it's kind of been now the top end of the rest in this past year's range. If you take a look at the trend strength indicators, you can see that as well, that it's very, very noisy. It has been noisy this whole time, which means that these indicators are not really taking off like you see during this bullish trend that we had. If you look at the daily chart, it's trying to get some kind of bullish. In fact, it's gotten up to a pretty strong bullish trend, but as you can see, as bullish as we've been, it's still been unable to really break out. And you see why? Because there's a lot of volume up in this area at these levels. So very significant volume at 140, and we have not only a dividend coming up here, it's dividend payment coming up at the end of this week, but then you have earnings on the 24th, so in 9 days next week. So it's a significant time, breaking out of the upper Bollinger Band today, but that's strong with the earnings coming up. And you can see the last 3 earnings, the stock has had a negative response. I mean, this only lasted 1 day there, but the last 3 earnings, there's been a negative response, and this trade, without a trade resolution, that's not really helping Caterpillar. You would like to see the dollar take more of a move to the downside, and it's been kind of holding up here this whole time. It's there's been we've had a week into the week last week, but it's still not a decline enough to really help a multinational company like Caterpillar out. So if the stock does hit this resistance, which you expect, stocks to hit resistance, you expect that resistance to hold until it doesn't. So if it does hold that resistance with the earnings coming, then we can look at saying, okay, what if we were to buy the 135, which is not at the money, it's out of the money, but if we were to buy the 135 put and sell the 130, you can see that at current volatility levels between now and August expiration, a move down below 130 is definitely within the realm of possibility. I mean, the one standard, well, that's 2 standard deviations. Let's get to 1. There's your 1 standard deviation move. So definitely within the realm of possibility to drop down that far. You can see where 130 is on this chart. It's basically towards the bottom end of this volume range that we're in. So definitely attainable. And you can see if I were to buy that 135 put and then sell the 130 to reduce the cost, it brings my cost down. So if we do break out to the upside, I know at worst I'll lose $126 per spread at worst. Knowing that if it really takes off to the upside, right, and gets up into this, like, say 146, 147 range, then I'll probably end up losing about half. And then we'll know, right, if it breaks that high, you don't have to sit there and wait to lose the other half. It's probably not going to drop below 130. You just take a small loss and move on. But if it does go up and does drop to 130, then you have a 3-to-1 reward to risk ratio as it is, with a maximum loss. Of course, if you get out at ultimately a half of that, then you end up with about a 6-to-1 reward to risk ratio. That's a pretty decent reward to risk ratio there. It's kind of speculating on this resistance to hold and keeping your losses pretty darn small if the resistance doesn't hold, if the earnings were to break this out and move on to these new highs. At that point, you can look at doing a different kind of a trade, a bullish trade, maybe a return move back down to the old resistance and trade that up. But until then, with the earnings, keeping the volatility, you can see with earnings coming out with this spread, if volatility does crush, it won't hurt us. In fact, it will actually help us a little bit with the negative vega that we currently have, and of course you have positive theta as well. So it's a way to speculate on an earnings result without being too aggressive and having too much at risk. All right, well, that does this for today. Now you've heard from me. I want to hear from you. Use that link that's popping out in the top right corner of your screen that goes to our Market Outlook forums. Make sure you subscribe to our site, but let's keep the conversation going there. Open up any new threads with any questions or comments you have for me about tonight's video or anything we didn't discuss in tonight's video that obviously pertains to the topic. And obviously you can always reply to anybody else's threads as well. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video down below. Follow me on Twitter for more content in between videos, and join our community at marketscholars.com, as well as the community that we've created on Facebook. Have a great rest of your evening, everybody, and we'll see you all tomorrow.